Most beginner investors spend months researching dozens of dividend stocks when three Vanguard ETFs could do the entire job for them and pay them more reliably along the way. The financial media pushes complexity because complexity sells courses. But the actual math on dividend income strategy points to a boring, repeatable answer. Low-cost, broadly diversified Vanguard funds that compound and pay you every single quarter. In this video, I am going to show you the three best Vanguard ETFs for long-term dividend income, what each one actually pays, and how a beginner with a few $100s a month can realistically build a cash flow stream that starts replacing real expenses. Not in theory, in actual dollars. Three ETFs, one recurring income system, and a number at the end of this video that will change how you think about the next 10 years of your financial life. So the real question is, is this actually worth starting with a few $100s? Or is dividend income just a game for people who already have a lot of money to begin with? Here is exactly what this video delivers. I am going to walk you through three specific Vanguard ETFs, what they are, why they work, what they actually yield, and how they fit together as a complete dividend income system. Not a complicated system, not a system that requires you to pick individual stocks or read earnings reports. A simple, low-maintenance, beginner-friendly system built entirely on funds that Vanguard already manages for you. And here is the number I want you to hold on to until the end of this video. If a beginner investor puts $300 a month into a balanced split across these three funds, starting today, and reinvests every dividend paid along the way, the projected value of that portfolio at the 30-year mark is over $340,000. And the monthly dividend income that portfolio would generate at that point is not $50. It is not $100. I will give you the exact figure at the end, and it is the kind of number that makes the starting point feel completely worth it. But first, we need to talk about how most beginners think about dividends, because the way most people approach this is backwards, and it costs them years. Most people look at a dividend ETF the same way they look at a savings account. They see the yield percentage, they multiply it by what they have, and they think, that is my dividend income. And if the number feels small, they move on. That is the wrong frame entirely. Here is the right frame. You are not earning interest. You are building an ownership stake in hundreds of companies that pay you a share of their profits, automatically, on a schedule, whether you log in or not. The question is not what the yield pays you today. The question is what the compounding system builds over time when every dollar those companies send you goes straight back into buying more ownership. That is the engine. Reinvestment. Every dividend payment automatically purchases more shares. Those shares generate more dividends. Those dividends purchase even more shares. It is not a linear climb. It is a curve that bends upward over time, and the longer it runs, the steeper that curve gets. The reason most beginners underestimate this system is because the early numbers are intentionally boring. They are supposed to be. You are not in year one for the year one income. You are in year one to plant something that pays you in year 10, year 20, and year 30. The people who understand that distinction are the ones who actually get there. This is exactly the kind of income breakdown I run on this channel every few days. Real numbers, no fluff, no get-rich-quick framing. Subscribe so you catch the next one before it drops. Now here's the mistake that trips up almost every beginner who starts researching dividend ETFs. They find a fund yielding 8, 9, 10%, and they think they have found the best option. More yield equals more income, right? Wrong. And this mistake is costly. A high yield is not a reward. In most cases, it is a warning. When a fund's yield jumps dramatically above the market average, it usually means one of two things. Either the share price has dropped sharply, which mechanically inflates the yield percentage, and that price drop happened for a reason. Or the fund is invested in assets that are paying out unsustainably high distributions to attract attention, which often ends in dividend cuts, capital erosion, or both. The three Vanguard ETFs I'm about to walk you through do not have the flashiest yields on the internet. One of them yields around 3%, one yields around 4%, one yields around 4.5%. None of them are going to make a finance influencer's thumbnail with a neon number and an exclamation point, but they are the funds that actually hold up. They are built on companies with real earnings, real cash flows, and real track records of paying shareholders consistently. The boring yield that keeps paying is worth 10 times the exciting yield that disappears. Dividend payments are not guaranteed. Any company can cut or suspend a dividend during tough times. That is a real risk. The way to manage it is to own diversified, well-capitalized funds built on quality companies, not to chase the highest number you can find. That is what separates a dividend strategy that builds wealth from one that quietly destroys it. So how do you actually tell the difference between a safe dividend and a trap? Here are the checks I run before trusting any fund or stock with a role in a long-term income portfolio. First, is the yield sustainable? If a fund's yield is significantly higher than its historical average, find out why before you buy in. A sudden spike in yield is a red flag, not a reason to celebrate. Second, is it broadly diversified? A fund holding 200 or 300 companies is far more resilient than one concentrated in 10. If one company in a broad fund cuts its dividend, you barely feel it. If one company in a concentrated fund cuts, you feel it immediately. Third, is the fund's income covered by actual earnings? For stock-based ETFs, that means looking at whether the underlying companies are profitable and generating real free cash flow, not just borrowing money to maintain payouts. Fourth, does the fund have a history of maintaining or growing its distributions over time? Consistency matters more than peak numbers. A fund that has paid a growing quarterly dividend for 10 or 15 years is a fundamentally different animal than one that launched recently with an attractive rate it has never had to defend through a recession. Fifth, what are the expenses? Vanguard is famous for this, but it is worth stating explicitly. High expense ratios silently drain your returns year after year. The difference between a fund charging 0.06% annually and one charging 1% sounds small. Over 30 years on a growing portfolio, it is tens of thousands of dollars of your money that evaporates in fees. Vanguard's expense ratios on these funds are among the lowest in the industry. That is not a small thing. Let me show you two real scenarios that flip the expectations most beginners bring into this. Scenario 1. You are looking at Vanguard's High Dividend Yield ETF, VYM, and you notice the yield is sitting around 4 to 4.5%. To some beginners, that sounds unremarkable. They look right past it and go hunting for something higher. But here is what that fund actually holds. Over 400 companies, heavily weighted toward established names in financials, healthcare, energy, and consumer staples. These are businesses that have been paying shareholders for decades. The yield is not flashy. The fund is not flashy. But it has survived multiple recessions, multiple market crashes, and has continued paying quarterly distributions through all of them. The 4.5% yield on a fund like this is not a consolation prize. It is proof that the income is real, diversified, and durable. That is a different kind of number than it looks like on the surface. Scenario 2. You are looking at a lesser-known high-yield income fund, not Vanguard, advertising a 10 or 11% annual yield. Your first instinct might be to think, that is the one that is actually going to move the needle. But look closer. The fund launched 3 years ago. Its net asset value has declined by 20% since inception. The distributions have been partially funded by return of capital, meaning the fund is essentially handing you back your own money and calling it income. The headline yield is real in the sense that it shows up in your account, but the portfolio underneath it is quietly shrinking. Over 5 years, that 10% yield combined with a declining principal produces a total return that a boring 4% fund with a growing base beats by a wide margin. The scary-looking low yield is actually the safer bet. The exciting high yield is actually the slower drain. Now let me walk you through the 3 Vanguard ETFs and how they fit together as a layered dividend income system. Layer 1, the foundation. Vanguard Dividend Appreciation, ETF, ticker, VIG. This is the bedrock. The reason it belongs in Layer 1 is not the current yield. It is the quality filter. VIG holds companies that have a minimum 10-year track record of growing their dividends year over year. That single requirement eliminates a massive amount of junk and concentrates the fund in financially healthy, consistently profitable businesses. The yield sits in the range of about 1.8 to 2% at any given time, lower than the others, but the total return profile and the compounding behavior of the underlying companies make it the stabilizing anchor in this system. When markets get choppy, the companies in VIG tend to hold up better, and they keep raising their dividends even in tough years. That is the Layer 1 job. It keeps the system intact when everything else gets volatile. Layer 2, the income engine. Vanguard High Dividend Yield, ETF, ticker VYM. This is where the current income comes from. Over 400 holdings, a yield in the 4 to 4.5% range, and a history that goes back to 2006, through the financial crisis, through the pandemic, through multiple bear markets. This fund is the reason the portfolio actually generates meaningful cash flow in the near and medium term. It is not trying to predict which companies will grow the fastest. It is simply owning large dividend-paying businesses across every major sector of the economy and collecting the quarterly payments they send. Layer 2 is the income engine. It funds the reinvestment cycle that makes everything compound faster. Layer 3, the global growth kicker. Vanguard International High Dividend Yield, ETF, ticker VYMI. Most beginner investors skip international entirely, and that is a mistake. Not because international stocks always outperform, but because geographic diversification protects you when domestic markets underperform for an extended period. VYMI holds over 1,000 international dividend-paying companies across developed and emerging markets, and the yield is typically in the range of 4 to 5%. International dividend payers have historically offered higher yields than their domestic counterparts, partly because foreign companies tend to pay out a larger percentage of earnings as dividends by cultural and regulatory norm. Layer 3 adds income, adds diversification, and adds exposure to economic growth happening outside the United States. That is the growth kicker. It expands the system beyond borders. Together, these three layers give you quality growth, domestic income, and international exposure. A complete dividend income system in 3 funds. Let me give you the number you're actually starting with, and I am not going to dress it up. $300 a month across these 3 funds split evenly with all dividends reinvested. In month 1, your dividend income, the actual cash those funds send you, is somewhere around $1.50. In year 1, your total portfolio contribution is $3,600. The dividends paid that year are roughly $100 to $120. That is about $10 a month. That is less than a streaming subscription. It is a fraction of a phone bill. If you came to this video hoping for a number that sounds impressive at the starting line, that is not it, and I am not going to pretend it is. But here's what that number actually is. It is a seed, not a tree. And the difference between the people who build real dividend income and the people who do not is not that one group had more money to start. It is that one group understood the difference between a seed and a tree and planted it anyway. Here is a number that makes a lot of beginners pause. The blended yield on this 3-fund system, across VIG, VYM, and VYMI combined, is approximately 3 to 3.5%. And for a lot of people who have seen other funds advertising 6, 7, or 8%, that sounds like falling behind. It is not. It is actually one of the strongest signals you could ask for. Here is why. The higher the blended yield on a broad market dividend fund, the more likely that yield is saturated with companies paying out more than they earn, companies in industries with deteriorating fundamentals, or funds using financial engineering to manufacture distributions they cannot sustain. Our 3% to 3.5% blended yield is lower than many alternatives on purpose because the underlying companies are not paying out everything they have. They are retaining earnings, reinvesting in their own growth, and raising their dividends year after year because they can afford to. That is the definition of a sustainable income system. The yield that looks lower is actually the one with room to grow. Now let's pay off the number I planted at the beginning of this video. $300 a month. all dividends reinvested, split across VIG, VYM, and VYMI, assuming a blended average annual total return, dividend income plus share price appreciation, of approximately 9%, which is consistent with the long-run historical average for diversified dividend-focused portfolios. Year 1. Your portfolio value is approximately $3,800. Monthly dividend income? About $10 to $12. Year 5. Your portfolio value is approximately $22,000. Monthly dividend income? About $65 to $70. Year 10. Your portfolio value is approximately $55,000. Monthly dividend income? About $160 to $170. Year 15. Your portfolio value is approximately $110,000. Monthly dividend income? About $320. Year 20. Your portfolio value is approximately $190,000. Monthly dividend income? About $550. Year 25. Your portfolio value is approximately $260,000. Monthly dividend income? About $750. Year 30. Your portfolio value crosses $340,000. And the monthly dividend income that portfolio generates, based on the blended yield of a three-fund system compounded over 3 decades, is approximately $830 a month. That is not a windfall. It is not retirement on its own. But it is $830 every single month that arrives in your account, whether you work that month or not. That is a car payment eliminated. That is a utility bill covered. That is the first piece of financial breathing room that does not depend on your employer's approval. And this is what people mean when they say dividend income changes your relationship with money. Not because it makes you rich overnight, but because there comes a point in the build at year 10, year 15, where you start noticing that a real, growing portion of your monthly expenses is being covered by assets you own. That shift in how you experience money is the whole point of this. But here's a question worth sitting with. What if instead of starting with $300 a month, you dropped a single lump sum of $5,000 into the right Vanguard dividend stocks, not ETFs, individual stocks, and walked away? The math on that is a completely different story, and the number at the end of it is one I think you need to see. That video is on your screen right now. These are not random videos. They are episodes of the same system, built to show you what dividend income actually looks like at different entry points, different time horizons, and different strategies. Watch the next one before you decide anything. Drop your answer in the comments right now. If these 3 Vanguard ETFs could cover one specific monthly expense in your life, one bill, one payment, one recurring cost, what would you want it to be first? Tell me below.